Welcome to this explainer. Today, we're breaking down the actual mechanics of corporate capital structure. We're going to look at how a management team really decides between using debt or equity, taking us from foundational finance theory straight into everyday boardroom reality. If you've ever wondered how massive companies fund their operations, or why they don't just borrow endlessly, and how all of this impacts the stock you own, well, you're in the right place. Let's get right into it.
Okay, here's our roadmap for today. We'll start with the cost of capital, look at the factors affecting capital structure, and then visit the perfect world of Modigliani-Miller. After that, we'll hit a reality check with corporate taxes, figure out how to find that optimal capital structure, and wrap up with real-world corporate financing.
So, Section 1, the cost of capital, and how companies actually go about minimizing their funding costs.
Look, at the end of the day, to create true shareholder value, a company has to find investments that generate a higher return than what it costs to fund them, right? That baseline hurdle, that is your weighted average cost of capital, or WACC. And hey, if a company has run out of positive return projects, they shouldn't just sit on a pile of cash. They need to return that capital back to the investors so they can put it to work somewhere else. Just hoarding it, that literally destroys value.
Now, the WACC formula itself is actually pretty intuitive. You're basically just taking the cost of your debt, multiplying it by your debt weighting, and adding that to your cost of equity multiplied by the equity weighting. But here's the absolutely crucial caveat. In places where interest expenses are tax deductible, you've got to calculate that cost of debt on an after-tax basis. So you multiply the nominal cost of debt by 1 minus the marginal tax rate. This little tax shield, it's a massive driver of corporate behavior, as we're going to see in a minute.
And when you're looking at these components, just keep in mind that debt is almost always cheaper than equity. Why is that? Well, it's because debt holders are at the front of the line. They have a priority claim on the assets if things go south. Equity investors, on the other hand, take on way more risk by sitting at the very back of the line. So naturally, they demand a higher rate of return to make up for that extra risk.
All right, moving on to Section 2, the internal versus external factors affecting capital structure.
So we know management wants to minimize WACC, but it's not like they can just wave a magic wand and pick their funding costs out of thin air. So what's actually moving the needle here? Well, it's a mix of internal and external forces. The total amount and the type of financing a company needs, the actual weights in that WACC formula, are driven mostly by internal stuff. Things like the company's specific business model or where they are in their corporate life cycle. I mean, a heavy-duty manufacturing plant is going to look totally different from a lean software startup, right? But the actual costs of that debt and equity, those are dictated by big, top-down external factors. We're talking broad market conditions, where interest rates are at, and how investors feel about that specific company's risk profile.
Which brings us to Section 3, Modigliani-Miller, and what happens in a quote-unquote perfect world. To really wrap our heads around how these pieces fit together, we need to temporarily leave reality behind and step into a theoretical vacuum. This was built by Nobel Prize-winning economists Franco Modigliani and Merton Miller way back in 1958. They laid out these 5 super strict assumptions, most famously the idea of perfectly efficient capital markets with 0 taxes and 0 bankruptcy costs. Under those exact conditions, they hit on Proposition 1, capital structure irrelevance. Basically, they proved that a firm's value is driven purely by its future cash flows, not by how it pays for itself. Think of it like a giant pizza. Whether you slice that pizza into 4 massive equity slices or 8 mixed slices of debt and equity, the total amount of pizza, the overall value of the firm, is exactly the same. The math behind this is actually really fascinating because you're probably thinking, wait a second, if debt is cheaper than equity, shouldn't loading up on debt lower my overall WACC? Well, in this perfect vacuum, no. If you look at the rising blue line, you'll see that adding cheaper debt perfectly offsets itself by driving up the cost of equity. Why? Because the more debt you pile on, the more financial risk you're dumping onto your equity holders, and they're going to demand higher returns for taking that on. The end result? That green WACC line stays completely flat. You can shuffle your funding mix all day long, but your overall cost of capital won't budge an inch.
Okay, time for Section 4, a reality check where we reintroduce corporate taxes.
When Modigliani and Miller finally adjusted their model to include real-world corporate taxes, literally everything changed. Because interest is tax deductible, having debt gives you this amazing tax shield. You can see here how the top blue line, the value of a levered firm, actually separates and grows higher than the unlevered firm. It grows by the exact present value of that tax shield. And even better, WACC actually goes down as you add debt because the cheapness of the debt is now overpowering the rising cost of equity. Honestly, if you take this model to its extreme logical conclusion, it implies a company should be completely 100% funded by debt.
That leads us right into Section 5, finding the optimal capital structure and the static trade-off.
But let's be real, you look around and companies are obviously not 100% financed by debt. Trying to pull that off would be a disaster. And that introduces our next big dose of reality, the cost of financial distress. This is the heart of the static trade-off theory. Just trace that curve for a second. At the lower end, piling on debt creates that nice tax benefit and boosts the firm's value. But as that debt mountain gets higher and higher, the very real threat and cost of potential bankruptcy starts dragging the value back down. So maximum firm value? It happens right at that exact peak on the curve. That's the sweet spot where the extra benefit of the tax shield perfectly cancels out the rising risk of going bankrupt. That right there is your theoretical optimal capital structure.
And finally, Section 6, Real-World Corporate Financing, where we translate all this theory into practice.
Okay, so we found the perfect theoretical peak on a graph. Great. But taking that peak and applying it to actual day-to-day boardroom decisions, that's where human behavior and messy market realities take the wheel. In the real world, managers can't just pinpoint their exact optimal peak while market prices are bouncing around all day. So instead, they set what's called a target capital structure. It's usually a comfortable range, maybe saying they want between 30 and 50% debt. And what's super interesting here is they usually base this on the book value of debt and equity, not the market value. Why? Because market prices are volatile and don't really reflect the cold hard cash the company actually invested. Plus, big players like rating agencies rely heavily on book values for credit ratings, so management naturally aligns their targets with that.
Now, when a company actually needs to go out and raise funds, they tend to follow a very specific behavioral pattern. It's called the pecking order theory. Basically, managers will almost always use their own internally generated cash first. It just makes sense. It avoids the hefty transaction costs of going to the market, and it doesn't send any weird signals to investors. But if the internal piggy bank is empty, step 2 is issuing debt. They really treat issuing new stock as an absolute last resort. Why? Because announcing a new equity issue usually sends a glaring signal to the market that management secretly thinks their own stock is overvalued right now.
To wrap things up, I want to leave you with a really fascinating concept to chew on. It's called the free cash flow hypothesis, introduced by Michael Jensen back in 1986. We spend so much time talking about debt as this huge risk, right? But what if we looked at debt as a disciplinarian? See, agency costs happen when managers take excess cash and blow it on corporate perks or terrible acquisitions instead of giving it back to you, the shareholder. But when a company takes on massive debt, it forces management to get highly efficient. The absolute terror of having to make those mandatory interest payments might just be the exact pressure they need to stop recklessly spending your capital. So it begs the question, does adding the very real threat of bankruptcy actually force executives to run a better company? It's a pretty provocative thought to end on. Thanks for joining me for this explainer on capital structure, and keep questioning the numbers.